type, nice coat, white coke. How you live with that smoke? Hop in, jock in. I'm just kidding, I'm broke. Sit a lot, I've been waiting for the day I don't get my pay. Check will make me happy instead of me getting laid. Never done in the middle with a gun. Put a hole in his chest with a torso don't fall right. In the sun, but until the desert does, we don't have no fun till we chillin' at my graveside. I'll be wishing I'm dead. I've been missing my friends. Get me out of my head. All the letters I sent. I'll be wishing I'm dead. I'll be wishing I'm dead. I've been missing my friends. Get me out of my head. All the letters I sent. I'll be wishing I'm dead.
Okay. What a start. So, okay. No rest for the weary. It's okay. Freaking wind's going like crazy outside. So, I thought this was hilarious that so we'll go over so there was a guy on Tannor on Future Investing's that debated SoFi. So we'll get to that in a second. But so PayPal blew you away with their life-changing announcement. What was it, a week ago? And they made the big point of doing the presentation. They're trying to copy Apple. And what did he announce? Smart receipts. That was basically his they were going to do smart receipts. Wow. Amazing. And the market was like, yeah, we're going to take 5% of PayPal on that. And then they blew people away with earnings, 12% nosedive after earnings. You got to love that. So anyways, so might as well chronicle the underperformance that is fintech investing, because I don't understand why it's so popular. I really don't understand why. I don't see what's interesting about fintechs at all. But people like to watch the freaking PayPal SoFi videos on YouTube. So I guess, but so they had this pop up, and all the SoFi channels were like, oh my god, big announcement. It's like, okay, here we go again. We just went through this with PayPal. So what possibly could be the big announcement? And then, oh wow, they're teaming up with the freaking NBA. Cool. Wow, so cool. This is amazing. What a life-changing friggin' partnership for SoFi. Amazing. So now let me get this straight. So they're barely profitable. They just were profitable the first time ever this quarter. So now they're going to pay for the naming rights to a football stadium, like the newest, biggest football stadium in the NFL. And now they're going to have a partnership with the NBA. Like, that's expensive. That's a lot of freaking money for a company that's just getting off the ground, right? Barely turning a profit at this point. Man, they're just shelling money out. And let's not forget NBA partnerships, okay? So you got the Miami Heat named their freaking arena after FTX. Okay, so let's not think that having a partnership with the NBA is some shining beacon of a great, solid company, right? FTX got in there. What else? FTX. Oh yeah, who can forget? They had a partnership with the Golden State Warriors, who, guess what? The Golden State Warriors got sued, but that's another thing. So the fact that they partners with the NBA, who cares? Like, that doesn't mean anything. It just means they're going to spend a lot of money on that deal. Whatever this deal is. Oh yeah, here's, you gotta love this. The NBA just doesn't really care. You want to give them money, they don't care. So be it. I'm sure the Warriors are getting sued over this, but no. But we got, SoFi. They're going to give money away every week, and I'm sure this deal is going to be pretty expensive. I doubt I don't know if we'll get the particulars of this deal. We won't get it from the NBA side. Maybe SoFi in their filings. So, yeah. And they were all so excited. But the main reason I wanted to do this is, so Tannor had this guy on, which I'll give him credit. Good for you, Tannor. You actually brought on a contrarian opinion, which a lot of these channels would never do this. So, but it was kind of funny. so we'll go over some of the parts, and then this guy wrote an article on Seeking Alpha, which is like the guy I got from Seeking Alpha. That's how I contacted him, and he came on my channel, which I probably want to do more of that, because it's actually like every person I've reached out to is willing to come on Seeking Alpha so far. So I'll try and find more topics that I can have people come on for. So let's go to this. All right. So we'll play a few clips from this interview, and then we'll go to Gary Gordon's article. So, because everyone's calling him a clown and a joke and an asshat and an old boomer. So we'll read, like, what did he actually write? Okay, let's just not base it on the video itself. So we'll get into who he is, and maybe, but don't just call him a clown, SoFi people, because you're in an underperforming asset. So maybe you should listen to this guy. He is literally in the space of he analyzes banks, right, and mortgage companies. So he's in this space as an analyst. I think he's like retired. So here's the first point I'll cover. Okay, hold on. You should be able to hear this.
Negative growth product with plenty of competition. How can I take market share?
Yeah.
In financial services, I learned over time, it's incredibly easy to take market share. It's not a challenge. I've got to do one of two things. On the deposit side, I can only do one thing, which is to pay a lot.
Right.
If I pay more than my peers, I'm going to get deposits. I saw a TV ad for SoFi in the last few days. We're paying 4.6% plus cash bonuses, which they didn't describe online. Sure, if I pay, as we speak, SoFi's deposit costs are a little over 4%. The average bank branch.
So he basically is telling you, yeah, okay, it's not that hard in banking to get deposits if you offer promotional deals, right? You offer promotional deals, the highest interest rates, people will move their money to your bank. That's not the hard part, right? The hard part is keeping those customers when you have to turn down. At some point, the growth will start to slow because you can't keep raising the promotional product because it's an expense. At some point, you have to turn that down, and you have to keep some of those customers, hopefully, but they might just go to the next company that has a deal. So he's just saying there's nothing that impressive about a bank growing deposits by offering higher interest rate promotional deals. That's not really impressive. So the SoFi people that harp on, the biggest thing they can harp on with SoFi is it's growing customer base, new accounts. They that's what they like. The first thing in their presentations is new accounts. So he's just like, that's not a big deal, is what he's getting to. It's not a big deal. If you're going to offer promotional, interest rates, people will flock to you. So, but that's not the hardest part about banking. All right, next part. I thought that was interesting. Good point by him, I think. So, okay, this part, 1630.
Say that, if I'm Google now, I can keep growing rapidly because I've got an oligopoly on a product.
But you don't think that SoFi could get there?
Not a prayer, not in financial services. Well,
I'm telling you, I put my freaking fist on the ground. Tannor and these SoFi people think that SoFi is going to replace JP Morgan. Like you could see it when he talks. They think it's inevitable that SoFi will become this monster, like 200 billion market cap bank that will rival the likes of JP Morgan. Like, it's just like, and this guy's like, he's practically laughing at this comment by Tannor. Like, he's about to laugh about like the sheer lunacy of thinking that. So anyways, if you want to believe that, so be it.
Yeah. If you look at SoFi itself, they're spending a lot on technology, and obviously any company today, if they're gonna talk about their growth, it's based on technology.
Right.
Do you honestly think that JP Morgan has never heard of artificial intelligence? Capital One doesn't have a technology budget.
Right.
At
the one point I've said, they had to impair the value of their technology division because it was growing slower than the expected rate when they bought it. It's a fact. So to say that SoFi is blowing away in their technology business, they're not. They're just not. And his point, I've said this to some degree. You're telling me that Jamie Dimon, like if SoFi actually did start becoming, a freight train, let's say, maybe, but why would other banks buy their technology, business, or use their technology assets, or pay a premium for it. They could just do it themselves. Like, what do they need Galileo for? You don't think JP Morgan or Capital One can't do the same thing on their back end? Like, but they have to sell you on the technology business, because if they didn't sell you on the technology story of SoFi, it's just a bank, right? But let me tell you, it's just a bank. It's just a bank. That's all SoFi is. It's a bank with a lot of personal loans. So
Hundreds of banks aren't, and bank consulting firms aren't offering the same thing.
Right.
That somehow I've got to believe that SoFi has figured out, technological wizardry or customer service management that none of these companies are thinking about.
It just, like, be real. This is one of the most competitive sectors of our economy, banking. There are thousands of banks and other types of businesses in this space, card processors and all sorts of things. Fintech is this little teeny. For some reason, people are obsessed with this little teeny speck of the banking industry that you could call fintech. I don't get why you people are so interested in fintech. I really don't, because all I see is underperforming companies when I look at fintech. Like, I look at it, I compare it to some of my industrial or retail holdings, or even my growth ETF, and I just see an underperforming asset. I don't understand why you're so excited about these companies that don't perform. They don't perform well over periods of time. The markets perform better, and other things you can buy, like cybersecurity. So there's that part. We'll go to 1930. Okay, let me go to that part. I don't want to play the whole thing. Okay.
Let's give it 2-3 years and see there. Let's see what happens when they to their personal loan credit quality when we've got a weaker economy. Let's see the impact of rapidly growing those deposits at the highest rates. We'll find out. Let's see where they're going to put the.
So this was the other part that the SoFi people say, is they say that SoFi's already been tested, because we had one bad year, 2022. So they said SoFi's been tested through hard times. You can go look at 2022. The unemployment rate didn't drop, right? So it was 2022 was an odd time. Like, kind of, it was a recession. I think they called it a technical recession. So some metrics showed recession, but then other things you'd look at, like unemployment rates, were not there. So, like, when we have a real hard time, this company has not been tested. Has not. When the unemployment rate goes like 4 or 5%, people start losing jobs. So, and then they have this huge book of personal loans. When people are losing their jobs, credit, how's their credit scores of their applicants going to look at that point? Are they going to keep their growth numbers? They have not been around long enough for you to know how they will perform. So I would agree with this. Like, you can't possibly say that SoFi has been tested. The whole time SoFi's been a public company, it's been an amazing economy in the US. I don't know how you could disagree with that. So you should be concerned with a company with this much personal loans on their books, how they're going to do in a bad times. So
all that money, all those deposits that they're growing.
Well, they could just put it in treasuries.
Well, then they'd be losing money.
Well, at 4%, you can get 5% right now. I mean,
no, not on a treasury, you can't. And they're not paying 4, they're paying 4.6 plus a cash bonus is their advertisement.
That it's 4.6.
Do you really think that's a great strategy for a bank? Like, what is he trying to say? So you think you should be offering promotional rates above what treasuries pay to get customer deposits to keep growing, and then you buy treasuries and lose money? Like, I don't get where Tanner's going with this. That sounds like a terrible business to be in. Like, because you have to, if you're going to keep getting the customer deposits, you have to offer the best promotional rates. So if you're paying more than what treasuries are paying, the bank's in a shitty place at that point.
For direct deposit, I think their average deposit is actually less than 4%. I think right now it's 3.8%.
It's a little over 4. It was in the fourth quarter. It was either 4 or a little over.
I don't have those.
I think Gary at that point was just like staring at the monitor, like, this. What are we doing here? This kid is like killing me. Like, he doesn't know what he's talking about. All right, next part. Oh, this is the last one. I didn't watch beyond this.
Short-term treasuries, these sorts of things, that there could be a large amount of flood into SoFi's products, like their Invest product, for example. Do you think that, like other banks, that there could be a potential benefit getting out of this bad macro environment?
In their Invest product, is there anywhere else you could invest outside of SoFi?
Yeah, absolutely. I think it's a matter of a mix of where you're banking may actually be where you want to also invest. And
Well,
whenever you're gaining new
this is
customers
not.
at 2 point
I
something
love
million a
This is my
year,
favorite part.
you know,
This is another thing that I've seen a number of companies try to pitch this. We've got the core product that the customer wants, and we're going to cross sell them 500 other products.
Yep.
Right.
We're going to build an
One,
ecosystem.
this is so far from a new idea. Wells Fargo is always a bank that pushed some. They used to all their quarterly earnings tell you how many products each one of their customers had.
Yeah.
Cross-selling has been around for a long time. Every bank tries to do it.
Mm-hmm.
And all these new fintechs, magically, they say, we've got some product that's going to create and some system, which SoFi has a very pretty picture, that we're going to cross-sell everybody everything.
Yeah.
One, history says that it doesn't work. That's not what we do. I pick Schwab for this, and I pick, TD Bank for this, and I pick somebody else for that, depending on, maybe who I know.
Like, okay, so for me, like, again, I'm with Gary on this. I don't care about one individual company and its ecosystem. I really don't. I have a online bank. I have a community, a credit union. I have a brokerage, 2 brokerages that are not even related to my bank, right? JP Morgan and Schwab. I don't care. So I'm with Gary. Like, I don't care. I don't feel any I don't feel compelled that I want to deal with one company. I don't. I picked like 5, 6 companies I want to deal with because I looked for good deals. Like the user interface is important. Like there used to be a lot of products USAA offered. Actually, they kind of built an ecosystem. USAA. They used to offer like every product under the sun you could imagine. They weren't just a bank. They were an insurance company, a travel agency. You could do mortgages, obviously, and credit monitoring and all this. And slowly over time, they've pared all those services down, and they've cut a lot of it. So they're down to now they're just like mortgage company, insurance bank. So they've streamlined it a lot. So like with what Gary's like, this, it's just not what people do in America. This whole idea that you're going to go to one bank and that's it. That's your only you're going to build out the entire ecosystem of that one company, and you won't go anywhere else. You're stuck with them. Like it doesn't hold up. I've never seen anything research to say that that's how consumers act in America. So, and I'm one example of saying I don't do that, and I wouldn't. I like to have different companies that I deal with. I don't. It's not even a hindrance. So I don't know about other people. That's just my opinion. But so that's that part. I'm not going to listen anymore. So it's kind of funny. Like, let me pull this up. So like the SoFi again, YieldMax has a freaking Reddit channel, and so does SoFi. SoFi's got a few, but so they posted this, and then they're all just like, man, Gary got dismantled. Imagine that. If you're a SoFi person on Reddit, you obviously think Gary did terribly. So I will say, props to Tannor for bringing on someone with an alternative perspective on an investment. That's a clown investment, but still, most channels wouldn't do this. Most SoFi people, they only talk about the positive. So, but some of these people get it, good from both sides. And then here, Gary's a turd. Oh, that's just brilliant on your part. I don't see any dismantling. Yeah, Gary stated his points. Tannor did not provide solid counter arguments. He was just being neutral. Gary did shed some light on the business model financials. Yes, he did. So he compared SoFi to Redfin COVID bubble. He didn't compare SoFi to Redfin. That he did not. He said he analyzed Redfin. And that was one of the other companies in the last year or so that he's analyzed that was similar to SoFi. He said that in the video. So this person didn't even read the whole thing. He's not a wealth manager. Gary is investment analyst. He's an investment analyst. Okay. So So let's look at the article. So this is the actual article that he wrote. So maybe if you didn't have Seeking Alpha, you couldn't have actually seen what this man actually wrote, because he put strong sell, and that's why they wanted to find someone. Which when I did Tesla, I looked for a guy that posted a strong sell also. That's why I talked to the prop notes guy. So I did the same thing basically. So let's see what he said about SoFi. And this was written January 16th this year. So Sofi's products are mature, growing modestly with competition in the market being strong. So that's what he's making point, is like it's a very competitive industry, banking. Their rapid growth plans are risky and likely to be disappointing relative to its current valuation. Strategy to build trust and lifetime relationships with members is unlikely to overcome its strong competition. So again, he's saying like, this whole ecosystem banking is just not going to work, and it's never worked before. So company valuation is more on hope than on reality. So if you look at a price to book ratio, like price to book, SoFi is right up there with JP Morgan right now. I think it's like around 1.6. So it's a very expensive bank at this point. I don't think anyone could disagree on that. So, well, I don't want to go through the whole thing. So this is some of the reasons he says a strong sell. So you've got the student loan business, which they were also excited when student loans came back to being paid. And then imagine like a month later, they weren't even talking about that anymore at SoFi. Again, like, well, he would propose in this article that student loan growth rates are deteriorating. So that's not really a growing business segment of banking, is what he's arguing. SoFi pushed that a lot on people to say that's where their growth would come from. And then he shows this chart. Okay, on SoFi's current primary loan product, unsecured consumer loans. Yeah, last time I checked, it was like 80+% of their loan book was unsecured personal loans. I don't think the 10Q is out yet for this quarter. This chart shows the growth rate history of credit card and other consumer credit, excluding mortgages. So his point would be that personal loans are cyclical with the economy. So you can't say that this is going to be a growth driver of SoFi, because history would show that during COVID, when interest rates were low and people, maybe were out of work, they needed personal loans. So you could see it skyrocket, but it's come down quite a bit since then because interest rates are up now. So it's more expensive. Unemployment is still low and people are back to work. So there's not such a need for personal loan products at this point. So that's one of his other points. So there's that. Finally, the growth rate of SoFi's new hot product, namely consumer deposits. So this is the big story that the SoFi people want you to believe, that their huge inflows of consumer deposits will continue forever. And that's why you should love SoFi. No. Under the pandemic, consumer deposits grew at 6% a year. Not growthy, but not too bad. I like how you write sometimes, like old manish. Then deposits surged as customers put much of their COVID checks in the bank. Yes, you could see the savings rate did go up during COVID. I think I saw that. Yeah. Consumers are now spending down their excess deposits, so growth the next few years will be well below 6%. So he's saying deposits could slow because the savings rate's going down now that we're past COVID. So let's see, supply chain, student lending. He doesn't see growth. Unsecured loans I could spend a whole freaking video talking about the fact I've never seen a bank have this many personal loans on their books, and it was growing from the last 10Q I looked at. So they're bigger, and that's concerning because they were talking about diversifying other products, and it was not happening. Actually, they were even using credit facilities to take loans to give even more freaking personal loans out. So what else does he say? We'll go down. So he talks about some other banking assets. 1 second. Okay. Potential holes in SoFi. Okay, this is what he's writing. Strategy hole number 1, our acquisition of SoFi Bank was an important step. So he's like, when they got the bank charter, his response, really, that puts SoFi in the exclusive club of 4,200 banks. So they talked about how amazing it was. Like there's like 4,000 banks in the US. Hole 2, sizable financial capital and resources required. Yes, SoFi is a big fintech, $5 billion in capital last year, spent $500 million on technology products development, but Capital One is also a competitor. It has $53 billion on equity. Okay. So he's saying like their technology spend is not that impressive when you look at their competitors who are much bigger at this point. So, and then he cites JP Morgan was talking about artificial intelligence and some of the things they're working on. He talked about that in the interview we also went over. Strategy hole 3, we must develop best-in-class unit economics and best-in-class products. So that's the idea of you'll go to SoFi and use all their products because you want to be in that ecosystem. So stating that goal is easy. Doing it is hard. Is there evidence to date that SoFi is doing this? Not that I can see. Those $1.9 billion of losses date and minimal earnings expected for this year say that SoFi is far from achieving best-in-class economics. I've heard a lot of people really dislike the user interface of I think it's the brokerage part, the stock part of SoFi. So I used SoFi for a few months so I could get like $100. I think I got like $100 credit. If I bought a stock and I put some money in from my paycheck, I got points. So I got like, I think $100 and then I cashed out. But the thing is, my account is still open. So they might be counting me as a customer and there's like 3 cents in the account. I think like maybe 3 or 4 cents. Oops. All right. What else? Strategy 4, no company better positioned than SoFi to be a winner. So that's pretty debatable. First, it is ludicrous to believe that any company is going to be a winner in the financial services. Rather, this is the standard fantasy of industry disruptor fintech pitch. That's hilarious. Here, as proof, here's a fantasy of other fintech disruptors. So he's covered like other companies in the space: Rocket, Upstart, Robinhood. They all tell you the same thing. And they're volatile as hell. If you're gonna, if you can time the bottom on these things, you could do really well, I guess. But these are really volatile stocks, like extremely. You can go look at Upstart's chart. Oof. So that's what he wrote. So he covers housing, mortgage, and consumer finance. So this is right in his wheelhouse, right? His circle of competency is SoFi, is in there. So you can't say to the people like he doesn't know what he's talking about. Like he does know what he's talking about in this sense. So he did this for a living. I think he worked for UBS for a while, is what he said. And I looked through some of his picks. So where was it? So he did mention this. Like he said, sell Rocket back in March when it was like $8, I think, and then it shot up. But then he did another article in December. This one. So he was right on this. He said like to short Rocket in December when Rocket was like at its peak. So that was one on him. He's been covering this MGIC company, and you can see they show like the articles when they say buy or sell, and they look at the price history on Seeking Alpha. So he's been right so far. You can see all the green articles. He's wrote a strong buy, and you can see the stock is appreciating. So there's some track record here that he's been successful in some of his analysis. I don't want to go past that. That's as far as I'll say. So interesting. So I enjoyed it. And then also you can't like he associates with Jeremy Lefebvre. So there it is. If you want the foo-foo coverage, go look Strongman's channel. So I'm not going to beat a dead horse on that. But he is getting some pushback from people underneath, which is kind of funny. So where was it? Hopefully he didn't delete it. Why are all the comments hating on Jeremy? Oh, seriously, bro? Good God. Yeah, Jeremy makes more money from YouTube and his courses than investing. And then Tannor, that most likely not even true. Oh, Tannor, it's very true. Jeremy makes money on YouTube and subscriptions. Like he's losing money investing most likely. I don't know how you recover from 3 million, but this channel got a lot less trustworthy. Weirdly mean-spirited for a friendly conversation. Like again, here's another person that associates with Jeremy, and he's either pretending he's not aware of Jeremy's past or he just ignores it, I guess you could say. Like kind of the same thing that Ryan Williams went through, actually. So Tannor, with all due respect, don't tie yourself to this guy. Unsubscribing keeps deleting comments. That's just YouTube. But so there was their big announcement. Again, There's nothing impressive about these companies. I don't understand. Like, we can look at PayPal and SoFi, like 6 months, right? The mark, you're up 10%, S&P, SoFi's down, PayPal's down. If we go to 1 year, again, like, you're still losing to the market. PayPal's been getting wrecked. SoFi, you still haven't beaten the S&P 500. I am waiting for this story of growth with this company. Like, at some point, anything, I don't know. Like, I did my growth. I know I've beaten this with a dead horse, but my growth investment recently was a cybersecurity ETF, right? And it's a growth investment. So I take the risk, I accept the risk, and I'm expecting a outperformance of the market. That's why I bought it, right? And so far, I've been very right. You can see here on a 1 year basis, which I bought it like 6 months ago more. So 6 months. Okay. Again, where is fintech fit in your growth portfolio that you think it's going to perform so well? I just think that you're wasting your time. I don't understand why you're so excited. And like Gary said, fintech is in a very competitive space with a lot of players. To try and get some sort of premium on those businesses with all these competitors around you that could just come in if they see that whatever you're doing is working. There's 4,000 banks in the United States. I don't understand what's so exciting about fintech, just in general. I mean, beyond SoFi and PayPal, like, what is so interesting about this sector, or not even a sector, this space? Like, fintech is talked about more than anything on YouTube. I don't understand why you're so excited about these banks that just wrap themselves in this like stupid technology product, and in the end, they're just a bank anyways. So, cool. Maybe you'll be right someday. But so far, my growth investments have done better than your fintechs. And I know somebody called me out about PayPal once. I mean, I'm waiting. I'm waiting for where you're going to be doing well with these things. And don't forget, Tannor sells a course about 10x investing with SoFi. You can't forget that. So I make money for Dan's happiness. Oh, you're JP Morgan. That's the funny thing. The best banking investment has been freaking JP Morgan of all of them. The biggest one with the best CEO has been the one you should have held for this time. The other I mean, you would have done really well if you bought a regional bank ETF at the bottom when everything was crashing last year, the regional bank crisis. I mean, I thought about it for a while because I'm like, that's how I would have played. I wouldn't have picked individual, too much risk. But you could have, like, there was something there. As a KRE. Yeah. So if you had bought like, why does this chart look weird? Yeah. If you bought like, it happened in March last year, and then in May was like the end of the regional bank crisis, and you could see it recovered nicely after. I think you would have gotten a 40-ish% gain on it. I mean, there's a banking friggin' play where I think the risk was worth the return potential at that time. But no, you're just going to keep underperforming as a SoFi PayPal person. Again, you're investing in like a checkout button with PayPal, or SoFi, you're investing in some crazy customer deposit story where they don't get wrecked by some recession on their personal loan book. I don't know. I fail to see where you think that's going to compete with JP Morgan, the way they're constructed. So we will keep track of it as time goes on. So far it's score one for me, I guess, the good guys. Oh, well, KKR, Brookstone, and Blackfield. Oh, you're talking. Okay. I don't track asset managers and like KKR. I've seen people talk about it. It's not really my thing. So I've no good or bad on it. Well, thank you for listening. So at least we got Gary's perspective. Maybe I'll have Gary on my channel. Maybe I'll message him and see if he'll come on mine and we can talk more. I don't know. He seems like a nice guy. So anyways, thanks for watching, and we'll see you later. If you're a state worker, enjoy President's Day. My next videos, I don't know yet what they'll be. I'll be back to serious content. I'm not sure what to do next. I'll think about it. So I got more time. Audit season is wrapping up now, so doesn't make I know they don't make tractors. A good joke. Solid joke. I mean, like, if you wanted to put like like you saw my growth portfolio, I left like 15% for individual stocks. You know, you could have at it and put like 5% of your portfolio in it, but go ahead. But we know these people are not doing that. And they're like 50, 60, 100% of their portfolio is this barely profitable bank that is relying on some very risky growth narratives to justify the price it's at and the price that you want it to be to justify buying it. I don't see the risk adjusted return that where it makes sense. I'd rather like the cybersecurity investment. I thought had a better risk profile for where I think it's going. And I have some other very small macro or micro caps that have done really well. Again, risk adjusted return for what you're buying. And I don't think they think that way. The people that buy like SoFi and PayPal, the people that buy PayPal, you think it's going to be the next Meta. That's I think what their investment thesis is. It's going to do what Meta did because it is, bro. But it's not the same business. So thanks for watching, and we will see you later.